Good morning. Today is May 1st, 2023. Hope you're doing well. Hope you had a good weekend. We're going to start off with the big news. We had kind of alluded to it. We thought something was going to happen on Friday afternoon when we sent out the market memo. And sure enough, something did happen. First Republic was put into receivership um, over the weekend. Immediately, JPMorgan and PNC bid to purchase the assets. JPMorgan won the bidding. So the way this is going to look is that First Republic, which is now the second biggest bank failure in United States history, after Washington Mutual in 2008, it's bigger than Silicon Valley Bank, bigger than Signature Bank, and bigger than Silvergate. The First Republic is the equity holders will cease, the corporate bondholders will cease, and the preferred stockholders will cease. Depositors will be made whole, and the way they're going to do that is they were put into receivership. The FDIC has guaranteed the insured deposits, and also JPMorgan is covering the uninsured deposits. Having said that, $5 billion of the uninsured deposits will be wiped out, but those were JPMorgan's deposits that it deposited at the bank at the end of March. The transaction is structured the following way. JPMorgan acquires substantially all the assets and deposits, again, not including the corporate debt or the preferred stock. It does include the insured and uninsured deposits. That's number one. Number two, JPMorgan will pay the FDIC $10.6 billion and will also repay $25 billion of deposits from large U.S. banks and eliminate the $5 billion deposit from JPMorgan upon consolidation. That's number two. Number three, JPMorgan will enter a loss share transaction with FDIC, and this is probably the most critical component. So essentially, the FDIC will provide 80% loss coverage on single-family residential mortgages for 7 years and 80% loss coverage on commercial loans for 5 years. So let's say the loans are trading at 50 cents on the dollar. JPMorgan's only going to take 10% hit, and the FDIC would absorb the remaining 40%. In addition, the FDIC is providing a $50 billion 5-year fixed rate term loan to JPMorgan. The cost of the FDIC is estimated at $13 billion. So that's kind of where we are. It was a relatively complicated transaction. If you want the details or are interested in the details, please do let us know. We can easily forward you our notes on this subject. I think the big key here, though, is the depositors, again, with the exception of JPMorgan, will be taken care of. And the FDIC is going to incur some losses on the loans. For JPMorgan itself, they're going to be booking a one-time gain on the transaction of $2.6 billion. They will have some restructuring costs, but it should be $500 million accretive to net income on an ongoing basis, is accretive to tangible book value per share. Capital ratios are consistent, and the internal rate of return on the deal is greater than 20%. All that, Tom, thoughts?
Well, it was interesting. March Madness led to April Sadness, I guess is the short way of saying it. But Mohammed El-Arian had a great op-ed on Bloomberg this morning, and he used to be the second banana at PIMCO for a really long time. He's another notable mustache haver and talking head, but he basically put out what is essentially a takedown of the Fed. He basically says, how did this all start? Why did this all happen? And basically, he said, one, the Fed was wrong about the transitory nature of inflation. And so they signaled to these banks that, inflation was transitory, that we didn't need to raise rates that much, that they weren't going to raise rates that much. And so that basically opened the gates for the duration mismatch, because these banks basically said, all right, well, the Fed's not going to blow us up here, so we can go out long and we can buy these bonds. And then on top of that, there was a pretty clear lack of supervision, which the Fed finally took responsibility for over the weekend, which is to say that they weren't looking at these banks and whether or not they had bought instruments that could lose money should the Fed itself start to raise rates. And then on top of that, it's remarkable that it was a bank that was really known for being the best of the best. I mean, they catered the highest end clientele. They had the highest levels of customer service. It was a bank you really wanted to bank with if you had a lot of money. So it's not like they were out here selling mortgages or giving multiple mortgages to people with no income who lived in trailers, like they did in 2008. He was like, this is actually one of the cleanest, nicest, highest end banks in the world. And it was essentially entirely caused by a combination of the Fed sending out incorrect and wildly inaccurate projections of what they were going to do with rates, and then the bank turning around and taking that as gospel. And so it was a pretty interesting sort of read through on the situation. But ultimately, the conclusion is that it doesn't make the banking system more robust. In fact, it makes it more fragile, because what we have here is more consolidation. You've got a massive bank that's failed, and now it's another part of JPMorgan, which used to be a number of different banks that all failed and been rolled up underneath one bank. I believe, including Wachovia, which went under, is now Chase. So it's kind of it's almost the exact opposite of 2008. It's not the same. It's in fact the inverse of what happened. So it was a pretty interesting article.
Yeah, I think Wachovia might be Wells Fargo.
Is it maybe it was WAMU?
WAMU's Chase.
Yeah, WAMU's Chase. Okay. Yeah.
Too many W's, man.
Yeah.
I think one big key component to note here is that the taxpayer is not on the hook for this. The FDIC is the Federal Deposit Insurance Corporation, which all the banks buy into. So that's that. I mean, it's coming. And the losses are going to be funded with a special assessment on the banks. So I think in case there are headlines on that, that's something to note. Charlie Munger in the FT, you brought up that point about Muhammad Al-Arian. Charlie Munger on the in the Financial Times, again, Berkshire Hathaway's big summit is this Saturday in Omaha, Nebraska. And Charlie Munger was interviewed by the Financial Times over the weekend. And he said that on the banks, he said that it's not nearly as bad as it was in 2008, but trouble happens to banking just like trouble happens everywhere else. In the good times, you get into bad habits. When bad times come, they lose too much. And so Berkshire is not in the banks right now. There's too many temptations to do the wrong thing in banking. He did say he did have a couple of warnings. One was on commercial real estate. He said a lot of real estate isn't good anymore, especially in office buildings, troubled shopping centers. There's a lot of agony out there. And they also said that every bank in the country is getting a lot tighter on commercial real estate and real estate in general. And that's something that we've definitely seen anecdotally just here in Atlanta. We've had conversations, big conversations with big people locally, and even just the last week, that commercial real estate is really under some pressure. And then he also said that it's going to get very tough to have returns like those that were obtained in the past because of higher interest rates and because there are so many investors out there trying to find efficiencies and navigate that. And so he made a ton of his money on Costco. And he said it's just going to be more difficult to find those opportunities going forward.
Yeah, I definitely agree. I mean, the commercial real estate thing, I worry about Atlanta particularly because I don't know if you remember what it was like in 2008 when the commercial real estate market collapsed here, but there were just open lots that were empty for years and years. Now it is, I forget what they call it now, Avenues of Buckhead or whatever, where all those nice restaurants are, was an open construction pit for like probably 10 years, right across from the new Fido. They built this nice balcony on top of the bar and you look out into just pylons and dirt, and it was there for years and years. It didn't really get built up until probably 2013 or 14 when they actually started to make it into something. So all those cranes might be hanging out there and gathering rust pretty quickly, I think.
Yeah, I think that's definitely something to watch out. I think that I like Charlie Munger. I mean, I know he's 380 years old, but that also means he's been around and seen some things and has some good perspective on this.
He can see two things at once. Just look up a picture of Charlie Munger and you'll understand the joke.
We did have a client question on over the weekend about our response to T-Mobile, because we've been pretty vocal and assertive that, look, the free cash flow picture at T-Mobile is quite strong, and we don't think that has changed significantly, and if anything, that improved after the most recent quarter. So why is the stock continuing to struggle to move through this $150 price level? Well, SoftBank, which is the big Japanese conglomerate, they own 48 million shares, which is roughly 5% of the shares outstanding. But those shares do not trigger in terms of diluting the shareholders until the stock trades at a volume weighted average price above 150 for the trailing 45 days, which is to say, there's a kind of a lid on the stock at $150, because if you're an investor and you know that there's going to be this dilutive effect above 150, the value per share mathematically is less at 151 than it would be at 147, because you're getting diluted by 5%. And so there's this lid, and there are a lot of people pushing against that. So there are a lot of sellers at 150. There aren't a lot of buyers at 150. Now, I think ultimately that dam breaks. And I think one way that could break is just continue evidence of T-Mobile's underlying valuation. But then also there could be a deal. T-Mobile already has a large share buyback in place. I wouldn't be surprised if they come to a deal with SoftBank and just buy those shares and cancel them.
Yep.
And now other companies have gotten in trouble on that in the past. Verizon got in trouble when they bought Vodafone's share in Verizon Wireless, which was half of the company. But that was 50%. This is 5%. And I think T-Mobile's in a better situation right now because they're also less hamstrung by the dividend and pending CapEx.
Yeah, I mean, the thing is, at 151 you're worth less, but at 165 you're not.
Right.
So what you really need is that stock to just push through that 5% threshold, and then suddenly you're off to the races.
All right. Busy week. Today we have ISM Manufacturing at 10 a.m. That's going to be a key read on what the economy did in April, especially as it relates to prices and employment. Tomorrow morning, we have the JOLTS job openings report, which we know Jay Powell is going to be focused on very closely. We also have Starbucks, AMD, and Ford earnings in the evening. And then Wednesday's the big one. We have ISM services in the morning, followed by the FOMC meeting in the afternoon. Thursday, we have the ECB, the European Central Bank meeting in the morning, and then Apple earnings in the evening. And then Friday, it all leads up to the big jobs report. Although I'm curious how big the jobs report's going to be with the Fed meeting on Wednesday. And Tom, I'm curious what your thoughts are on that, because 2 days is kind of it's on the edge. Does the Fed know the number? If it was the day before, I would say the Fed does know the number. 2 days, I don't know. In which case, the Fed might come out and say something on Wednesday that might summarily get reversed on Friday, or vice versa.
Yeah, I think the way they're operating right now, at least as far as I can tell, is that they're just going to raise rates one time on Wednesday. I think they've sort of just etched that in stone. They feel comfortable with it. They're looking around. They're seeing that there's been a number of stickier inflation data points that they've seen over the last month. And I think they're not really looking to that employment report on Friday, or even really the JOLTS tomorrow on Tuesday. Yeah, tomorrow, that much. I think at this point, they've got 99.5% of the data they're going to get for the previous month. This last half is not enough to swing them away from that, is my thinking there. However, if the jobs number is negative on Friday, I think that's where they can start to point to potentially a change of direction. They can say, hey, that last one, they really got it. Look, we raised rates. And then the following, 2 days later, the jobs report was terrible. Maybe we've hit that threshold, even though you could argue that months and months ago, the jobs number was put that way because of a triple rate hike they did last summer. But I think that's, the way that they rationalize and talk is much more on data that's more recent and rate hikes that are more recent than maybe are really affecting the economy at all. So that's kind of how I'm leaning. And I think we get one more rate hike. I think the second one is probably more probable than not. And then after that, my guess is they're probably going to stay and pivot. Well, they won't pivot. But
they'll be data dependent. They'll call themselves data dependent.
But I don't think they give any sort of leaning one way or the other. I think that they have that option. And so they're not going to say we're going to raise rates again. They're going to let it fester for another month, and then they're going to probably raise again. I don't know. That's kind of what the data suggests to me.
Yeah, we'll have to see how much more tight credit tightens. I think that we're expecting some tightening of credit, and you can see it in some real estate areas now. But you've kind of been seeing in real estate for the last year.
Yeah.
Frankly, I mean, if you look at the cost to get a mortgage, if you look at, I mean, it's only natural the commercial real estate becomes more untenable as well. Question is, how does that filter through the economy? My guess is the Fed might say they need to see more on the disinflation front, but we'll see. With that, we'll leave it there, and we will see you tomorrow. We'll have the ISM manufacturing report, and we won't have the JOLTS report yet, but we'll definitely talk a little bit more about that. Thanks.